Bitcoin versus gold, unraveling the inflation hedge debate and investment realities. Welcome to today's video, where we'll be examining the ongoing debate between Bitcoin and gold as reliable inflation hedges, as well as exploring the realities of investment potential in these assets. The cryptocurrency markets are experiencing a downturn, with Bitcoin losing over half of its value and numerous smaller projects failing. Various experts have attempted to explain the situation, but none have fully captured the entire picture. We've all heard the standard narrative, which includes a global pandemic, unprecedented stimulus measures, manufacturing slowdowns, record inflation, and rising interest rates. While it's true that higher interest rates often trigger market sell-offs and a shift away from high-risk assets like cryptocurrencies, recent Federal Reserve actions don't provide the complete story. Cryptocurrency is currently undergoing an identity crisis, with debates surrounding its function as a store of value or a means of payment, the appropriate terminology, and the extent of decentralization. A significant question is, what year should we compare the current state of cryptocurrency to? Critics argue that the comparison should be to 1637, the year of the tulip mania collapse in the Dutch Golden Age. Studying previous speculative bubbles can help us understand current market conditions. The tulip mania story shares similarities with the crypto market, such as soaring prices, non-fungible tokens, NFTs, selling for exorbitant amounts, and the use of credit to leverage investments. However, the tulip bubble only lasted 7 months, while cryptocurrency has experienced multi-year bull runs for the past decade. Moreover, historians now question the extent of the tulip mania. So while some parts of the crypto world may resemble tulip mania, it doesn't accurately represent the entire situation. Crypto proponents prefer to compare the current state of cryptocurrency to the internet in 1995, as both are new technologies. In 1995, only 15 million people had internet access, and the technology was widely mocked. Today, the total number of Ethereum users is around 15 million, prompting the belief that cryptocurrency usage is on the verge of exploding, just as the internet did. Nevertheless, using Ethereum users as a benchmark is somewhat arbitrary, and a broader scope would yield different results. Additionally, the value created by internet users compared to cryptocurrency users doesn't align with the optimistic outlook. Critics argue that most of the 15 million active crypto users are speculators, not individuals deriving actual value from Web3 services. Bitcoin believers, on the other hand, argue for a comparison to 1920s Germany, which experienced hyperinflation. Bitcoin has a fixed supply, and its primary purpose is to store value. Ultimately, the ongoing debates and comparisons serve to highlight the complex and multifaceted nature of the cryptocurrency landscape. In lieu of using income tax to finance the war effort, German Emperor Wilhelm II opted for debt. The concept was straightforward: secure a large loan to wage the war, and upon victory, impose war reparations on the defeated allies to repay the debts. However, the plan failed as Germany lost the war and was burdened with massive war debts it couldn't repay. Instead of receiving reparations, the Treaty of Versailles dictated that Germany would have to pay. There was still hope that Germany could settle these debts. The majority of German factories remained intact, as the Western Front was primarily fought in France and Belgium. However, when the first payment was due in June 1921, inflation spiraled out of control. As the government printed more money, the currency's value plummeted, with $1 eventually being worth over 4 trillion German marks. This economic catastrophe wiped out the wealth of German citizens who held cash. Proponents of Bitcoin often draw parallels between the United States today and Germany in the early 1920s, with increasing money supply and spiking inflation. Holding a fixed supply currency like Bitcoin could prove incredibly valuable in such circumstances. However, there are issues with this comparison. For one, crypto enthusiasts have been predicting hyperinflation for over a decade, with Bitcoin's creation in response to the 2008 financial crisis and government bailouts. Although inflation has finally arrived, Bitcoin has not yet demonstrated its potential as a reliable hedge against it. Gold, the traditional inflation hedge, has performed well, while Bitcoin has struggled. This can likely be attributed to speculation rather than belief in Bitcoin as an inflation hedge. Low interest rates and fiscal stimulus have driven people towards high-growth tech stocks and cryptocurrencies, which have since declined as interest rates rise and riskier investments lose favor. Contrary to its portrayal as digital gold, Bitcoin has been inversely correlated with gold. The real question is whether it will ever function as an inflation hedge. If Bitcoin could replace gold in this role, it would be a worthwhile investment, but the timeline is crucial. A rapid price increase is unlikely, and even if it took 30 years for the price to stabilize and grow, it might not be considered a good investment compared to average stock market returns. The history of clean technology investments in 2006 serves as a cautionary tale, highlighting the need to separate technological potential from investment potential. Despite the technology's value, clean tech companies didn't yield the expected returns, and the best investment at the time might have been simply installing solar panels on one's own home. Similar lessons can be applied to cryptocurrencies, emphasizing the importance of considering the long-term implications of any investment. Thank you for joining us in our exploration of the Bitcoin vs. gold debate and the intricacies of investing in these assets. We hope this video has provided you with a better understanding of the complexities surrounding inflation hedges, as well as the importance of separating technological potential from investment potential. As you consider your investment strategies, remember to take into account both historical lessons and current trends to make the most informed decisions possible. Don't forget to like, subscribe, and share this video with others who may find it helpful, and leave your thoughts in the comments below. Until next time, happy investing!